Banks make billions of dollars from lending money. So why would they sell the very loans that generate their profits? It sounds counterintuitive. After all, lending is their bread and butter. But behind the scenes, banks sell mortgage notes every single day, and they do it for reasons that might surprise you. And here's where it all gets interesting. When banks sell those notes, they open the door for private investors to step in and earn the kind of steady, secured income that banks have been making for decades. In this video, we're going to unpack the entire story: why banks sell mortgage notes, what really happens behind the scenes, and how you, as a private investor, can benefit from these transactions. Let's start by breaking down what a mortgage note really is. When someone buys a home, they sign a promissory note. That's their written promise to repay the loan. It lists the loan amount, the interest rate, and the payment terms. Then there's the mortgage or deed of trust. That's what secures the loan to the property itself. Together, these two documents form what we called a mortgage note, essentially a real estate-backed income stream. Now, most people think banks just hold on to those notes and collect payments for 15, 20, or even 30 years. But that's not how banks actually operate. Banks don't want their money tied up for decades. The real business model revolves around velocity, how fast their money moves. They want to lend it out, sell the loan, get the capital back, and lend it again. That's the secret behind why they sell notes. It keeps their money in motion. Imagine this. A bank lends $300,000 at 6% interest. Over time, the bank could make hundreds of thousands in interest, but it would take decades to realize that income. Meanwhile, the capital is stuck. By selling that loan, the bank gets its $300,000 back right away, plus maybe a small premium, and can use that cash to issue new loans, earn new fees, and keep their business moving. It's like recycling money. The faster they recycle, the more profit they generate. Now, where do these notes go? They don't just get sold randomly. There's a massive behind-the-scenes marketplace called the secondary mortgage market. This is where banks, institutions, investors buy and sell notes, performing and non-performing alike. Trillions of dollars flow through this market every year. Big names like Fannie Mae, Freddie Mac, hedge funds, and private equity groups are active players. And yes, private investors can participate too, often buying individual notes or small pools directly. It's the secondary market that keeps the mortgage industry liquid and flexible. Without it, the entire system would slow down. So why exactly do banks sell notes? Let's dig deeper. The first reason is liquidity. Banks need consistent access to cash to fund these. The second reason is risk management. Not every borrower has the perfect credit. And third, there's regulatory pressure. Banks must meet capital ratio requirements set by regulators. Holding too many loans can make their balance sheet look risky. Selling notes help them to stay compliant and maintain financial stability. And then there's non-performing loans, notes where the borrowers have stopped paying. These are a drain on the bank's resources. Rather than manage collections or foreclosure, they often sell those loans to investors at a steep discount. And that's where opportunity lives for private investors. When a bank sells a note, whether performing or non-performing, it often sells it below its face value. For performing notes, maybe it's a small discount. For non-performing ones, it can be 40, 50, 60 cents on the dollar. Let's look at an example. A borrower owes $100,000 on their mortgage. The bank decides to sell that performing note for, let's just say, $90,000. You as the investor buy it. The borrower keeps making payments on $100,000 balance, not the $90,000 you paid. That means your return is actually higher than the original note's interest rate because you bought the income stream at a discount. Now take a non-performing note. Let's say the borrower fell behind. The banks sell it for 50,000. You can reach out to the borrower, offer a modified payment plan, and get them back on track, turning that non-performing note back into a performing one. Or, if necessary, you can take control of the property, which might be worth significantly more than what you paid for the note. Either way, you've created value. That's the beauty of mortgage note investing. It gives you multiple paths to profit while being secured by real estate. And here's something most people overlooked. This system benefits everyone involved. Banks win because they free up capital and offload risk. Investors win because they gain access to discounted, income-producing assets. Even borrowers can win when investors work with them to find solutions instead of facing foreclosure. It's a win-win dynamic that keeps money flowing through the economy. For investors, mortgage notes offer something truly special. Steady, secured, passive income. You're not dealing with tenants, repairs, or late-night maintenance calls. You're simply collecting payments, just like a bank. You don't have to be a landlord. You can be the lender. And because every note is backed by real estate, your investment is protected by something tangible. If the borrower defaults, you still have the property as collateral. That's the level of security that you don't get from stocks or crypto. Now, why is this especially relevant today? With higher interest rates, stricter lending conditions, and more borrower under financial pressure, banks are sitting on growing numbers of non-performing loans. And as they offload these notes, the opportunity for investors continues to expand. This means more inventory, more flexibility, and more ways to enter the note investing space, often at prices well below market value. It's a powerful time to get educated, connected, and ready to take advantage of this cycle. So to bring it all together, banks sell mortgage notes to keep their money moving, reduce risk, and stay compliant with regulations. And investors who understand this system can step in, buy those notes at discounts, and generate consistent income secured by real estate. This market has been around for decades, quietly helping banks, institutions, and now private investors build wealth through paper instead of property management. You don't need to be a millionaire or a bank to get started. You just need to learn how to evaluate notes, understand the risk, and connect with trusted sellers. If you're ready to learn more about how mortgage note investing can help you create steady, secure cash flow, why don't you visit ritzelnotes.com. At Ritzel Notes, we help investors understand, evaluate, and invest in performing and non-performing notes, so you can build wealth confidently and securely. Thanks for watching. If you found this video helpful, please give it a like, subscribe, and share it with others who want to learn how to make their money work smarter. And remember, you don't have to own the property to profit from real estate. You can own the paper. You can be the bank.